So welcome to the 7th lecture of Energy and Finance. So my name is Gijsbert Zwart, and I will be teaching the final stretch basically up till the end of this course. So which will be 8 lectures basically, 4 weeks. And this whole series actually of 8 lectures will be on real options. So real options have to do with investments essentially. So I'll give an introduction into that first, and then I'll go into describing what are investments, and then what will be the questions that we will be particularly interested in when we are studying investments using a real options framework. And the thing that's really drives real options is uncertainty. So we'll have a look at uncertainty and decision making under uncertainty. So as you know, the book that goes with this part of the course called Investment Under Uncertainty, and basically that's what we will be doing here. So there's decisions here, like investment decisions, and there will also be other decisions. And so the last part we are going to look at, how do we figure out what are the optimal decisions, in particular, the best decisions that an agent, a firm, for instance, can make. And in order to study that, I'll start introducing today the Bellman equation. We'll carry on with that actually in the second lecture. But let's start with an outline. So we'll have a look at investments in energy projects. So in the first 2 weeks we have been looking at such investments. So these might be investments in conventional power plants, or perhaps also in renewable energy, as you see here in the pictures. But the common characteristic of these types of investments is that they are big and they're irreversible. So big in the sense of it requires a lot of capital, very capital intensive industry, energy industry. And irreversible, once you have built a power plant, a coal plant, as you can see on the left-hand picture, or a wind farm, it's not really an option to, it is an option, but it's not an option that you would use to break down this plant whilst it still can be operating, because the investment costs are so high basically. So that's one characteristic. Another characteristic is that the value of these projects typically depends on a lot of variables, and some of which are typically very risky. And there you can think both on the cost side. So the costs for the conventional power plant might include input prices, like prices for the gas or the coal that you burn in these plants. They might also include carbon dioxide permits, if these play a role, which you might have to either buy or which you get, and for which you'll face some opportunity cost. And all these prices go up and down, as we've seen in the market. So there's an active market for all these commodities in which prices vary by the day or even faster. And also on the revenue side, of course, you have to deal with prices which are uncertain, which move. So you can think of the electricity price. Of course, if you sell electricity, obviously this price is going to change day by day, or hour by hour, or even 15 minutes by 15 minutes if you look at the balancing market. And gas prices, again, they vary by the day basically. Also, if you have the input and the output prices, the difference between these prices might be important for you, because that's going to drive your profits. So that's called the price spread. And apart from input and output, you also have perhaps subsidies, which from the government or from some regulator, which might go up and down on a bit slower time scale, but still they are uncertain. Also, regulation is one uncertainty that might impact, or typically will impact actually on your investment value. So that's investments in energy projects, so big, irreversible, and uncertain. So we'll need to model these, and we're going to model those investments. In order to do that, we have to model this uncertainty. In order to do that, we'll have a look at what we have seen already in week 3, which is the introduction of processes describing those risky variables. And particularly, I've been looking at these ETO type of processes, continuous time processes like geometric Brownian motion. So here, for instance, the price for, say, electricity might be depicted, which moves up and down over time, but follows some stochastic, so uncertain process, kind of random process if you wish. The geometric Brownian motion is just one example of these, so where there's a particular drift, so the drift here, which is the average growth rate of this price, called mu, and there might be some volatility, sigma here, which measures basically the size of these uncertain fluctuations driving this price either up or down. So this first part is deterministic, but the second part, in particular this DZ part, is a stochastic contribution to this price, which gets updated again day by day in an uncertain way, exact uncertain way. So that's a geometric Brownian motion. Of course, you have seen some other processes briefly discussed, like mean reversion processes or even jump processes, where prices might not be continuous. So we'll need modeling tools, so we have these tools to model these risky variables that we are going to take into account in modeling the investment decisions, which are based on these uncertain processes, these stochastic risky processes. So what we are going to do then indeed is look at investments under such uncertainty. So basically the question that we need to address here, that we need to answer in this part of the course, is how should we evaluate such an investment, an irreversible investment, which you cannot easily undo once we have done it, when these costs or these payoffs, these returns to these investments are uncertain, so they move up and down over time. And the typical questions that we would like to address here are, first of all, the basic question: should we do this? Should we make the investment? Is it profitable to make this investment? But that's not all, because we might also want, these prices, these costs are going up and down over time. So there's also a question of timing. When should we do this investment? If today the present value of this investment is positive, does that necessarily mean that we have to do this, that we should do this investment today, or might it be better to wait sometimes? Of course, we'll see that might actually be the case. Actually, this picture you might have seen. Nice picture you might have seen before, and basically illustrates this. So this blue line is the price, the good that you're producing, say electricity. It's going up and down, and you might want to wait until this price is high enough, so crosses some threshold here, which is the red dashed line, the investment threshold, and only when this uncertain price, reaches this threshold level will it be interesting to make this particular investment, and it will then be up to us basically to compute, to the model to compute what is this particular optimal investment threshold, which will determine then when you will make this investment. Often there are also different choices that we can make. So do we want to make a big or a small, do we want to build a big or a small power plant, for instance, or do we want to have flexible technology or less flexible technology? And another question that we want to answer is, are all these answers, how do they depend basically on the uncertainties that we're modeling? So in particular, the magnitude of this volatility parameter, this uncertainty measuring sigma, this volatility, how does that have an impact on the answers to these questions, so on these choices of timing and of type of investment? So what we'll do in this part then is, ultimately the goal that we want to reach is, we want to reach a level of journal articles that address such questions in this energy context. So we'll have a look at the various journal articles, but in order to understand those, we have to build some techniques. We have to build some introductory tools, basically to work through these models. And for that, we use this book by Dixit and Pindick, Investment Under Uncertainty. So we'll do that in particular in this week, in the first two lectures, and carrying on a bit in the second week, elaborating on those as well. And in the second week, we'll also have a look at a working paper, which does this at a fairly pedagogical level, I would say, which is the paper by Murto and Nese. So we'll go into that actually in quite a lot of detail. So it actually describes the choice between different projects that we might want to invest in. The weeks after that, we'll go to slightly more advanced papers which we'll dive into as well, into the details. But as we go on, perhaps we'll focus less and less on the complete computational details and more on the ideas of these papers. So in the third week in particular, we'll focus on sequential investments. So these two papers here, so one from the Energy Journal and the other from the AER. And in the final week, which is the week actually after the Christmas break, we'll have a look at regulated investments. So that's important, of course, in the energy sector, particularly if we look at networks, so energy networks, the distribution and transmission grids, and also gas networks. They are heavily regulated, and so there's some additional component here to the revenue streams and also to the uncertainty that we will have to take into account to describe investment decisions in those kinds of regulated industries. So here we have a look at a paper by Ian Dobbs, which is from the Economic Journal, and a paper by Bert Willems and myself from the Rand Journal, which is more recent. While doing this, so that's the goal, is we want to have a look at these published papers. And you also have to learn something from them, basically, and learning is listening and reading, of course, but it's also doing. And so the doing part here is the homework assignments. So the first of these will be already due next week, and will be hopefully fairly easy and straightforward. Basically making sure that we will all be on the same page and that we understand the basic model that we are going to look at this week. So it will be on the basic techniques that we will be using, because we need to know those once we embark on reading those papers. So the second assignment will be due in the final week, so that's a week after Christmas again, and it will be related to the computational details, if you wish, and we're producing some of the results from the paper that we'll do in next week, in the Motor and Acer paper. So more on that will follow, of course, later, but so this first assignment will be already due next week, and I will give it to you actually this week after the second lecture. So what we'll do today in this first lecture is we'll look at investment in a firm that has a value which is a function of some price, the price of the output. So you can again think of the price of electricity that this plant is producing. And the question then that we want to ask in this model, in this paradigm basically, is when should we invest? And first of all, of course, have a look at the classical rule. Net present value should be positive, or the value of this project, the present value of this project, which will depend on its price. When is it bigger than investment cost I, and well, that might be the moment, the decision rule for you to make this investment. And then we will actually go on to look at a price which itself is uncertain or stochastic. And we'll see that then it might be actually optimal to wait a little bit longer. And that raises the question, how much longer? So what's the optimal timing? And that we'll start having a look at that. So we'll introduce the so-called Bellman equation, which helps us compute that optimal timing. And we'll introduce this today in discrete time, allowing us the rule basically characterizing the optimal investment strategy. But in order to then take this to a further level, we'll actually introduce the continuous time version of this next lecture. So that will be the second lecture of this week. In terms of text, today we'll basically mostly follow this chapter 4 from the book, from the Dixie and Pindick book, which is on dynamic programming. So that's the outline of this of today, basically, and of this last part of the real course. So let us go in the next video to looking at investments.